Hello, my name is Angela Owens with Phenomenal Business Solutions, and I help small businesses streamline their finances, increase their profits, and grow their business. So, today I will be talking with you about how floor plans quietly drain profit. So, the number one hidden cost is interest. Interest is accrued daily. So every day that your vehicle is sitting on the lot, it is accruing interest. So you really have to pay attention to what is going on, because if you wait 30 days, 60 days, 90 days, by that time the interest is gone and you haven't made any managerial decisions on each car that you have going on. Then we have the aging. So aging inventory costs far more than just the floor plan interest. As vehicles grow older on the lot, the expenses multiply in ways that are easy to overlook until they hit your bottom line. Like you have advertising. If the longer the vehicle waits, the more that you want to try to push that vehicle so that you can get it out. And then the insurance, depending on if you have basic garage insurance or if you have your insurance through the floor plan company. If you have it through the floor plan company, then each vehicle is insured separately. So that's a different insurance cost for each vehicle that you have. And then price reductions. The longer you hold the vehicle, the more you want to start thinking about reducing the price. So as you try to reduce the price, that cuts into your profit. And then, of course, the maintenance, depending on the quality of the components inside the vehicle, when you purchase it from the auction, it's possible that holding that vehicle is going to cost you money as well. Then we have the curtailments. Many floor plan lenders require scheduled principal payments that are called curtailments before a vehicle ever sells. So you have to pay this regardless. So if a vehicle hits 30 days, now you got to make a payment towards the principal. Then when it hits 60 days, another payment towards the principal, then so on and so forth. So if you're not moving the vehicle, you're starting to pay on it anyway. So holding those vehicles costs you money. Then floor plan fees. Depending on the floor plan company that you are using, it could be audit fees, which is charged when the lender comes and check your lot to see if you sent in the payment. Every time you sold a car, you're supposed to send in the payment for that vehicle. Then the wire fees, which is assessed basically payment processing fees, documentation fees, title release fees, late fees, whatever the case may be. You have to understand what each car is going to really cost you. Missed buying opportunity. So if you have money tied up into a vehicle that is not selling, you're tying up capital basically. So you have a vehicle that's just sitting there when you can go and purchase another vehicle that has a better chance at being sold. So definitely this is one that people are not thinking about. Price reductions. I mentioned that on another slide. So the price reductions, as your vehicle gets older, you are tempted to reduce the price to get it to sell. But when you do that, you're cutting into your profit. So in order to make sure that you have the right information for your dealership so that you can make good choices versus emotional choices, you want to stay ahead of that information. Reconditioning costs. So when you purchase your vehicle from the auction, it's a chance that some of them are ready to sell right away, but for the most part, you're going to have to do some repairs. And when you choose the car that you get, you have to think about how much it's going to cost your dealership to actually repair that vehicle, because that is going to cut into your profit as well. So you don't want to get a vehicle that's going to cost you a lot of money and a lot of time before it goes is ready to sell. So that's another thing that you want to think about. Insurance and overhead. Like I said, some floor plan companies offer insurance, and they will insure each vehicle individually. So you're wasting money by paying for insurance for a vehicle if it's not selling. Now, it's good if you have your own garage insurance, but some people just want to use the floor plans insurance, and that's going to cost you money. And also overhead, but overhead is going to be overhead sometimes regardless of anything else. But you do want all of your vehicles to be able to help you pay your overhead costs. And reduce cash flow. So cash flow problems often arrive before profitability shows any warning sign. As inventory ages, a compounding cycle begins and it tightens fast. The curtailments trigger principle, cash tightens, buying power shrinks, fresh stock suffers more units age, and interest rises on age units, and it's just steady ticking away at your profit and your cash flow. So dealers who track profit alone can miss this pattern until it becomes a crisis. Healthy cash flow is a direct result of healthy inventory turnover, and protecting one means managing the other. Emotional pricing. One of the most expensive decisions a dealer can make is refusing to let a vehicle go. When you've invested in a unit, reconditioning, floor plan advertising, it's natural to want to recover every dollar, but the market doesn't care what you paid. So emotional attachment to a price point causes dealers to hold vehicles past the point of profitability. Every extra week of waiting adds interest, overhead, and risk, while the vehicle's market value continues to fall. And I'll add to this is that if you really want to hold on to a vehicle, I suggest that you go ahead and pay it off of the floor plan so that it's yours and it's not, at least it's not accruing the money from the floor plan company. So that's still a decision that you have to make for your dealership. If it's a vehicle that you really want to hold on to, that you think you can sell, but you want to take it off of the floor plan so that it's not costing you on a daily basis to hold it. Here's warning signs that you are losing profit. These signals often appear before the damage shows up in your financial statements. If more than two of these sound familiar, your floor plan may already be quietly costing you. Rising days to sell. Your average days to sell is trending upward month over month. Vehicles are not turning as fast as they used to. Frequent curtailment payments. So, again, you don't want to be paying down principal and accruing interest constantly. So, decide if you want to go ahead and pay that vehicle off or send it back to the auction. Growing interest expense. Your monthly floor plan interest line is creeping upward even when total sales volume stays flat. Aging inventory over 60 to 90 days. A significant portion of your lot has crossed the 60 to 90 day threshold and is becoming the norm and not the exception. You need to figure out, are you buying the right vehicles? Is it the right season for you to hold that much inventory on the floor plan? See what's going on. And then tightening cash flow. Cash feels harder to manage each month despite steady sales. That's a classic sign that inventory costs are outpacing the revenue. So You want to protect your profit. Controlling floor plan costs isn't about luck or managing conditions. It's about putting the right habits and systems in place before losses accumulate. These 5 practices protect both your margin and cash flow. You want to review your aging reports weekly. Don't wait for the month-end surprises. Know exactly which units are aging and act before threshold triggered curtailments or require deep markdown. Track interest expense monthly. Make floor plan interest a line item you review and benchmark, not a number you discover in tax time. Move slow inventory early. Price to sell before major losses occur. And a small concession at day 30 costs far less than a forced markdown at 90 days. Price based on the market, not emotion. Use real-time market comps to set prices. What you pay for a vehicle is irrelevant to what today's buyer will pay. And there's software that can help you figure out what's the best price to set your vehicle so that you're not priced out and that you're not too cheap. And treat inventory speed as a profit strategy. Fast turns mean lower carrying costs, stronger cash flow, and more capital available for fresh inventory that actually sells quickly. Most dealerships don't lose profit through one large mistake. It's a bunch of small mistakes that add up over time. So managing your floor plan effectively isn't just an accounting exercise. It's one of the most powerful levers you have to protect both profit and cash flow simultaneously. So know your numbers, move with the market, and turn inventory fast. And I appreciate you for staying with me. And if you want to get in touch with me, here's all of my contact information. And I would love to sit down with you, and you can book a free profit and cash flow analysis where I can go through your floor plan information, and I can see if you're pulling the right reports and help you go through those things to make a solid plan so that you can increase your profits and grow your business. So have a wonderful rest of your day. Bye.